While the industry's done a good job of cleaning up their act and preparing their balance sheets, what we haven't done is learned our history lesson from 10 years ago or past cycles when we've stampeded through the door to replace reserves, replace production through new development. I think we're headed for massive cost inflation in the industry going forward.
Well, a warm welcome to viewers tuning into this virtual fireside chat that forms part of our mining investment series focused on the Americas. I'm delighted to be speaking with David Garofalo, CEO of Gold Royalty Corp and CEO of Marshall Precious Metals Fund and Chairman of the Board of Great Panther Mining. David, thanks very much for taking time to have a discussion with me.
Thanks, Adam. Thanks for having me on.
Great. So if we could start by just discussing your take on the gold mining sector at the moment, and in general, the investment thesis behind exposure to gold and gold mining. That would be great because, the mining sector is doing very well at the moment across the gamut of metals, and gold continues its bull cycle after some pullback this year. So just wanted to get your take on where we are in the gold market cycle at the moment.
Well, I think we're still fairly early in the game simply because I don't see an end to quantitative easing anytime soon. I don't see the prospect for significantly higher interest rates anytime soon. Real rates are in negative territory. The governments, on a coordinated basis across the world, are still quantitatively easing, in other words, printing additional money. They need to because they've strapped on so much sovereign debt to support themselves fiscally during this pandemic crisis, and even before. They have no reasonable prospect for repaying that debt in a fiscally responsible way. So they're going to have to print money and debase their currency and debase the debt in order to make that debt more sustainable and supportable in the current environment. So I think that speaks very, very well for the prospects for gold. And we're still not anywhere near what the all-time high is for gold on a real basis. If you go back to 1981, when we last had significant inflation, we saw gold go to $850 an ounce. That was in 1981 dollars. Of course, translating that into 2021 would be close to $3,000 an ounce. So while we achieved nominal highs in the last year or so over $2,000 an ounce, just a hair above that, actually, we're not anywhere near this all-time cyclical high for gold. So I do believe that we have that kind of runway in this environment. And if you buy into that thesis and buy into gold as an asset class that you want to invest in, really the choices are much broader than they ever were because of the advent of the ETF 15 odd years ago. There's a way to play physical gold, both for retail investors and for institutional shareholders who couldn't own physical commodities before, now have a way to play in that market on the physical side through the ETF. So that's great for the commodity, great for the industry. And then, of course, you can play gold equities to get that leverage proposition, both in terms of profitability and exploration. And then finally, the royalty companies provide that as well, but also insulate you from underlying cost risk, cost inflation risk, which I think is going to rear its ugly head in the industry in a very significant way in the coming months and years.
Excellent. Yeah, we'll delve into some of those points more specifically. How profound then is the need for sort of growth and resource replacement amongst the producers? If we switch to sort of looking at gold mining now, on the one hand, we've seen majors making great money. The fundamentals are probably the best they've been for quite a while. They're paying dividends, and generalists don't seem to have jumped in yet en masse. I just wanted to get your take as an investor and a corporate leader. The macro is obviously very strong, as you've outlined, but why have the mining equities, or certainly the majors, not seen this significant inflows from generalists that we've seen in previous cycles?
Well, I think part of it is because the general equity markets have been quite robust, and gold equities have been seen as insurance against a volatile equity market. But when the equity markets are going in one direction, by and large, there isn't that need for insurance or perceived need for that insurance. The other factor, of course, and you've touched on it, is the replacement of reserves has been lacking. In fact, we've seen reserves decline from their peak about 7 years ago by 40%, and that's largely through depletion. So we haven't, as an industry, replaced what we've been pulling out of the ground. And it's because, again, one of the factors you mentioned is because we've been paying dividends, returning capital to shareholders, and deleveraging. We had a fairly significant investment in new mine development, both on the base and precious metal side about a decade ago as we came out of the credit crisis. That led to massive cost inflation, massive debt on the balance sheets of mining companies across the world, to the point where the equity investors just steered clear, and the equities vastly underperformed the underlying commodities because that leverage proposition wasn't there because of the massive cost inflation we saw both in operating and capital costs. And so the industry focused on harvesting what it had built and doing that very, very effectively, cost stabilized, balance sheets deleveraged to the point where actually in the mining industry right now, we have net zero debt. That's unprecedented. The balance sheets are squeaky clean. Nobody's out there raising equity. In fact, they're buying back stock. They're doing all the things that you would expect a sustainable business to do. But the one element of sustainability that we're lacking as an industry is replacing reserves. What we sacrificed during that period of harvesting was reinvesting back in exploration and mine development. And that's why we find such an acute need for reserve replacement right now. The average mine life globally in the gold industry has gone from 20 years to 10 years over the last 7 years as a result of that harvesting effort. The grades of gold mines have halved over the last 15 years. And so the near surface high grade deposits, if we're having to go deeper, our costs are starting to escalate. And now we're faced with a backdrop of inflation in the general economy and an acute need to replace reserves and actually start to reinvest back into development to replace declining mines. That's a recipe, in my view, for massive cost inflation. So I'd say while the industry's done a good job of cleaning up their act and preparing their balance sheets, what we haven't done is learned our history lesson from 10 years ago or past cycles when we've stampeded through the door to replace reserves, replace production through new development. I think we're headed for massive cost inflation in the industry going forward.
Yep, certainly. And so what does that then spell in terms of, getting out of this tricky, this challenge? Is it a case of producers upping investment into growth, looking at the juniors, really companies like yours, leveraging the advantages of the royalties companies to help these juniors bring ounces online?
Yeah, so if I'm an investor, I want to position myself at the development end of the spectrum because that's where the existing producers are going to have to devote capital. And so I'm talking about the explorers, and you have to be selective there because that's almost like buying a lottery ticket. 19 out of 20 of those just don't work. They have a geological thesis, they drill it out, doesn't work. That's just the exploration game. It's a very, very high risk, low probability end of the spectrum. And then there's the developers, the ones that have more advanced projects, have a reserve or resource that they delineated, they're making an investment case. Those ones are going to be snapped up. Single asset producing companies are going to get snapped up as the producers who are not finding ounces are going to have to replace them through buying them. And so I would say that end of the spectrum, I think, is going to see more capital devoted to it. The producers are going to be struggling. The more established larger producers are going to be struggling to provide a leverage proposition to their investors if they see their costs inflating. And that's the challenge they face, and see their reserves declining. And by definition and arithmetically, the underlying value of their business is going to decline as the ounces in the ground start to deplete more quickly. And we've seen a fairly precipitous drop in reserves, as I mentioned earlier on. And that's why, frankly, I positioned myself in the royalty end of the business for the first time in my career. I've been in the business for over 30 years in an operating capacity, my development capacity. But I think now we need to be in the developer end of the spectrum. We need to be in the royalty end of the spectrum because the royalty companies are a source of capital for the explorers and developers. Mm-hmm. And also they provide that leverage to exploration and to the gold price, the underlying risk that's associated with cost inflation and operating capital costs and input costs generally. I think investors, as they seek to play the gold investment assets or play in that investment class gold, will look for that leverage without the cost inflation risk that comes with it. And I think royalties offer the best of all worlds in that regard. And we're there to provide capital to those explorers and developers. I think that's it's a symbiotic relationship that I think investors are going to appreciate, in general, in particular, as they start to deploy capital into the sector.
Yeah, absolutely. Just picking on a couple of things you mentioned there, I guess now will be quite a good time to introduce Gold Royalty Corp a bit more succinctly to our audience. It's a relatively new company, but you're certainly making a lot of moves at the moment, and there's been a merger with Eli Gold, I believe. Could you just take us through what's the state of play with Gold Royalty Corp and where you're at the moment?
Well, we started with 18 royalties through the spin out from Gold Mining Inc. We took royalties in each of their development stage assets in the Americas, all again, not producing. And we used that as a platform to IPO and raise $90 million US on the New York Stock Exchange back in March. And then very shortly thereafter, acquired Ely Gold, which gave us another 85 royalties, 4 of them producing, 8 in the development stage. So vastly diversified our portfolio and doubled the size of the company overnight. And so it gave us that scale, access to capital, and a diversified portfolio that we think royalty companies are looking for. And I think more importantly, I should say, is completely focused in the Americas, completely focused on precious metals. So you're not seeing any exotic royalties within our portfolio. And I think that's a criticism of some of these fledgling royalty companies that have come out recently. They're too diversified from a metal exposure standpoint. We're well diversified in terms of having now 110 royalties collectively within our portfolio across the pipeline from early stage to producing. But it's entirely focused on precious metals in the Americas. And I think that provides low political risk, a focused portfolio with optimum leverage to gold, and a $500 million market cap US, with the prospect of a significant re-rate as we integrate the Ely Gold portfolio into ours, and with a cash flow trajectory that would see our cash flow increase 5-fold over the next 5 years as some of these development stage assets start to achieve production status.
Excellent. Thanks for that quick rundown. And you mentioned diversity, and I guess your diversity is in the breadth of projects that you have, rather than, as you say, the commodity types. I'm just thinking of like Wheaton, and their sort of their journey and how they now have a cobalt stream. Obviously things change, but you mentioned that you're completely precious metals. So I guess your diversity comes in that sort of the breadth of projects that you've got. How can you offer the scalability to shareholders? What's the sort of strategy there?
Well, it's interesting. I mean, I have a half a dozen employees, and we could run a business 10 times the size that we have today with the same employee base. That's the scalability. And every dollar of royalty revenue that we acquire will go right to the bottom line, because our G&A costs aren't going to go up as we scale up. Mm-hmm. And our scalability, or rescaling with the Ely transaction, gives us quite a bit more weighting on the relevant indices like the GDXJ, which we graduated to just a month or two after our IPO. So there will be some natural buying that occurs, or organic buying that occurs after we re-rate on the GDXJ. So we see that hastening our re-rate. We see the potential for a company of our scale to get to 1.5 to 2 times NAV. We were 1 times NAV prior to this transaction. But typically companies our size, with our diversity of royalty portfolio and our market cap, should be trading at 50 to 100% higher than what we're currently trading. That'll drive down our cost of capital, make us much more competitive as we look to add new royalty opportunities in the portfolio. And we're going to be quite active in that regard, either through acquiring individual royalties, as we recently did, acquiring 5 royalties from Monarch Resources in Quebec, in the Abitibi region, or continuing our roll-up strategy. There's still plenty of scope for rolling up a lot of these orphaned royalty companies that are too small to be relevant to most generalist investors.
Yep, certainly. It is, yeah, as you mentioned, a competitive landscape, and you've got the lower cost of capital as an advantage you mentioned there. But how different is the landscape now for the junior miner, the junior gold company? The equity markets are better than they've been, certainly in the sort of last 10 years. Does that make it more difficult to strike deals? Are companies perhaps more willing to look for more specialist partners with expertise that you can offer, such as who's on your management team, for instance, could really be an attribute there.
Yeah, no, it's an excellent point. I would say for the junior end of the spectrum, it's still relatively selective access to the equity capital markets. So it has to be a significant geological discovery with a strong management team with a long track record of exploration success. Those people can still raise money selectively in the equity capital markets. But we've seen valuations come up dramatically in the junior space over the last year or so. We've seen that kind of deflate. There was initially a run up a couple of years ago, just around the time COVID started to hit in March of 2020. But then that's come off dramatically, and it's been much more selective access. So we've seen actually quite a bit of opportunity for us to look at royalties on advanced stage exploration prospects. So we see a lot of pipeline opportunities that we can continue to add into our portfolio on the royalty side. So I think we're still going to become and be a meaningful source of capital for the explorers and developers who otherwise can't access capital in a more traditional sense.
Yeah, absolutely. I'm just thinking about your merger with Ely and sensible moves that create value and scale for shareholders. How do you see M&A playing out, not necessarily for royalties companies, but across the gold sector at the moment? Is there a wave coming that's sort of backlogged from lack of mobility over these lockdown periods that we've been facing, or is the gold price perhaps a little bit too high to deter certain deals coming through?
No, look, what I would say, starting at the top tier, I think they're done in terms of large scale M&A. The big deals happened back in 2019 with Barrick Randgold, and then subsequently Newmont and Gold Corp when I was running Gold Corp, then still creating the biggest gold company by market cap and production at the time. I don't see the prospect for more consolidation at the top. They're already at sustainably high production levels, 5-6 million ounces, Barrick and Newmont respectively. I think then they have the risk of becoming too big if they merge beyond that. I see them tucking in things from time to time that make sense around areas that we're already operating in. And we've seen Newmont quite active in that regard, picking up a couple of pipeline opportunities more recently to bring into the portfolio and continue to populate their pipeline, but relatively small deals. I would say the prospect for significant consolidation exists more in the mid-tier, where there are just frankly too many of these companies, and they all are facing the prospect of declining reserves and declining production profiles. And as I said earlier on, if you're not finding it, you're going to have to buy it. And I would say some of these smaller scale, early stage producers, single asset ones, for example, are not here for a long time. They're going to be plucked at some point. I think the opening up of the economy that will allow for physical due diligence of assets will open up more M&A. I think that's been an impediment, frankly. I think the fact that equity valuations have become a little bit depressed, it could hasten the need for these companies to start to create scale and create relevance in the equity capital markets to attract that generalist investors. I think they're all recognizing these smaller hundreds of millions of dollars of market cap junior producers are going to clamor for relevance in the equity capital markets, and they're going to do that through M&A. That's the only way to do it, and get that scale and get to at least north of $1 billion market cap to attract that incremental investor and allow for that re-rate that they're looking for, lowering their cost of capital.
Wow, yeah, excellent. So lots on the horizon.
Yeah.
I wanted to touch on ESG, but and also your expertise, both as investor, but also corporate leader, and as a royalties company leader as well. You said something in the Northern Miner earlier in this year that was quite profound around what the industry has to focus on chiefly, and it was around water consumption, which I thought was really good, because quite often we hear the decarbonisation piece, and that is usually the sort of top line response, whether it's greenwashing or it is a genuine response from a corporate or a fund, etc. And so I just wondered if you could reiterate that and your views around some of the top points on ESG just for our viewers.
Well, let me just touch on decarbonization first. I think the industry is embracing that very, very seriously, and they're measuring it, so they're managing it much better than they ever were. And, when I was running Gold Corp, we built the first all-electric underground mine in the world in Borden. And it's inevitable that that technology will get scaled to a sufficient level. And I'm talking about mobile equipment and the like, to the point where it can be used in large-scale mines. That's inevitable. So the technology's there. It's just a matter of time to get that scaled to a sufficient level and help significantly reduce the carbon footprint in mines. So I'm very optimistic in that regard. I'm far less optimistic on our water management in the mining industry. And we consume a lot of water, far too much of it. And it's water that, in my view, is the biggest impediment to new mine development. Because generally we're going in environments that are water scarce in remote areas of the world. And we're often competing with existing users of water, agriculture and the like. And so that creates a lot of social upheaval. And I've said this before, wars are fought over water. And so we have to be much more responsible stewards of water. And when I look at the value creation chain at a mine site, the area where we use the most water is in tailings management. We need to get out of the business of traditional tailings impoundment. And the industry has been far too slow to embrace that. But if we're able to go to technology like, for example, dry stack tailings, which is a accepted technology, and it is being scaled as well. But I think if it's more broadly embraced, we're going to see a dramatic reduction in fresh water consumption and a dramatic increase in our recycling rates. And so when I was running Gold Corp, we actually launched an initiative called Towards Zero Water that would have seen us be a net 100% recycler of water within 30 years. And that was a moonshot objective. And frankly, the technology didn't exist to even achieve that. But we recognized if we didn't put out an objective like that, a moonshot objective like that, we would never develop the technologies as a company or as an industry in order to achieve that net zero water consumption target. But the industry needs to do that. The other element, of course, of tailings is the stigma associated with tailings disasters. They rarely happen. It's like being in the airline industry. Airline crashes are extremely rare, but when they happen, they're always catastrophic. And it's the same thing with tailings. And so we really need to get out of the tailings impoundment business, at least traditional tailings impoundment business, for those particular reasons.
Yeah, absolutely. It's been quite a few big and shocking headlines in terms of the social license aspects of mining over the last year and a bit. Very good. I just had one more question around your take on the crypto impact on the generalist investor, or indeed how that might infringe on an investor mindset. And just wanted to ask around the sort of patient capital approach or the patient mindset that might be needed for something like mining versus, or mining equities versus crypto, which can be very quick and rewarding, or certainly very volatile.
Well, that volatility will ultimately undermine its ability to be seen as a reserve currency. And frankly, cryptocurrencies are here to stay. I'm not disparaging them from that standpoint. The advent of blockchain makes digital currencies an absolute existential need for the economy. And so there will be digital currencies for the foreseeable future. And the argument I've made against digital currency, at least the valuations they're at right now, and not against digital currency as an asset class or the need for it, is the fact that there's no impediment to new entrants in the digital currency space. And in fact, now we're hearing governments talking about digitizing their own reserve currencies. Yes. In other words, they're going to take ownership of the digital currency market. Well, we'll know what happens to digital currency when that happens is the governments will then just make it another fiat currency, like their paper currency. And when there are no barriers to entry, there's no scarcity value. Whereas gold is very, very finite in quantity. And as an industry, we have a remarkable inelasticity of supply to price. In fact, as price has been going up over the last several years, supply has been going down because of the significant capital impediments to building new mines, the technical complexity, the social complexity of building new mines. The runway to building new mines is getting longer and longer. And so we won't see that kind of supply side response to higher gold prices that you might expect, particularly for new entrants who don't understand the industry and understand the barriers to entry. And so I think gold will increasingly be perceived as scarce, and cryptocurrencies will be increasingly perceived as not scarce, or the opposite of scarce. Again, any dog, and we have dog coins, any dog and his friend can create a digital currency, and central banks will start to do it. And again, that'll undermine that scarcity proposition. They've created the illusion of scarcity to, I guess, new entrants in the investment markets. And I think young investors understand intuitively and instinctively that their digital or their fiat currencies, are being undermined by central banks. And they're looking for ways to safeguard their capital. And so they're buying digital currency with that expectation that they will safeguard their capital. But with that kind of volatility and with the lack of barriers to entry, I'd say that's the opposite of providing protection to your capital.
And on that note, to the sort of younger investment audience, we have seen greater appetite for equities now, or moving money out of savings, not holding fiat, but actually sticking it into something that's going to appreciate, or looking for sort of quality companies, and that in itself is quite a boon generally for stocks.
Yeah, exactly.
Excellent. David, thanks very much for taking time to chat with us. It's been great, and really appreciate your insights.
Thanks, Adam. Thanks for having me on.